So contractors, business owners, real estate investors, equipment leasing is really popular towards the end of the year. And I talked about the differences in the previous video about the differences between equipment leasing and a regular equipment loan. There's some key differences, but I wanted to talk about the 5 different types of equipment leasing. And so the first one I want to talk about is either the capital lease, a finance lease, or a dollar buyout. So typically those under want to utilize leases, but they want to own the equipment at the end of the term. Usually, this is fairly popular type of financing, and then essence is you don't own it obviously until that dollar buyout is made at the end of the term. Uh, the other type of lease is a sales leaseback, and really the difference between that and some of the other leases is just what the type of financing this is utilized for. Usually, you have some equipment and you're looking for some work, maybe you pay cash or something for it, or it has some value, and you want to get some working capital. So typically, you'll do a lease against the equipment for the purposes of having that cash, but you're still able to utilize that equipment. So the third type is a true lease or operating lease. And a true lease, just like the true, when you think of the word lease, typically you think about renting. Like if you're leasing apartment, you're renting an apartment, and that's similar for the true lease or the operating lease. So typically at the end of the lease, you're returning the equipment at the end of that true lease. Um, the put option lease, or the put stands for purchase upon termination, and typically similar but different to the the first type of lease, the capital lease. Um, Usually at the end of the term, usually that put would be like for 10% of the equipment. The benefit of having a put lease, it gives you an option to purchase the equipment at the end of the lease, but utilize the equipment and usually have a lower payment, because it's a based on that 10% risk uh, assessment on the equipment. And last but not least is a TRAC lease, equipment lease. A TRAC is typically used for commercial vehicles, and the TRAC actually stands for Terminal Rental Adjustment Clause. And there's usually the option to purchase a vehicle at the end of the lease, but it's usually based on the estimate of that vehicle's residual value, the value of that vehicle. And uh, and then from a accounting standpoint, it's similar, uh, but the correspondent liability, you can have correspondent liability on the balance sheet. You uh, on that thing, but definitely those are the 3 or the 5 options on the type of equipment equipment leasing.